Welcome to this explainer. Today, we're tearing into a seriously fascinating open-source multi-strategy stock screener. Look, if you've ever stared at a trading algorithms backtest and thought, wow, this strategy is basically a money printing machine, well, you are definitely not alone. But there is a massive, often totally invisible secret lurking in financial backtesting that artificially inflates those numbers. Today, we're going to use this powerful open-source tool to expose that trap, understand exactly how a custom momentum breakout strategy works, and learn how to actually test algorithms against the unforgiving reality of the real-world market. Okay, let's dive right in. Here's our roadmap for today. 1. The backtesting illusion. 2. Anatomy of a breakout. 3. The survivorship bias trap. 4. Point-in-time reality check. And finally, 5. Under the hood. First up, Section 1. The backtesting illusion. I really want you to consider this question for a second. Why do most winning trading algorithms just completely fail in the real world? You know how it goes. You download some historical data, write a brilliant script, the simulation shows this breathtaking upward equity curve, and then you take it live and the whole thing falls apart. The crazy thing is, it's not necessarily because your code is broken. It's usually because the data you used was lying to you. The usual suspect here is a phenomenon called survivorship bias. Simply put, this is the logical error of focusing entirely on the winners, the ones who survived a selection process, while completely ignoring the losers who just vanished along the way. But when we're talking about algorithmic trading, and especially when backtesting against major indexes like the S&P 500, there's a highly specific, much more insidious version of this bias that we absolutely have to look out for. And that is forward-looking inclusion bias. The source material breaks this down brilliantly. Just imagine you're backtesting a strategy starting back in 2006, but you're using today's S&P 500 roster. You're testing stocks that were added to the index in, say, 2020, long after they had a massive 500% run-up. Your backtester pretends it could have brilliantly traded that stock back in 2015, when in reality, it was just some tiny small-cap stock that no S&P 500 screener would have ever looked at. It artificially inflates your returns because it's literally cherry-picking future winners. It's exactly like buying a winning lottery ticket after the numbers are already drawn. Which brings us to Section 2, Anatomy of a Breakout. So the open-source repository we're looking at includes a highly specific 8-criteria custom breakout strategy. Instead of just jumping at random price spikes, it filters for a perfectly stacked momentum alignment. The price has to sit above a cascading stack of moving averages. We're talking everything from the 21-day all the way down to the 200-day EMA. Throw in a new end-month high, confirm it with heavy relative volume, and ensure a baseline liquidity of at least 1 million shares. It's rigorous. What this is doing is brilliantly illustrating the concept of progressive momentum alignment. The algorithm isn't just throwing darts. Step 1 makes sure a short-term trend is actually happening. Step 2 requires heavy institutional volume to confirm the breakout is real, not just a bunch of retail noise. And Step 3 ensures this short-term explosion is happening within the context of a solid, long-term upward trend. The screener literally requires all 8 of those criteria to fire before it passes a stock. Now, Section 3, the survivorship trap. Let's see what happens when we put this to the test. Okay, what's genuinely shocking here is the sheer scale of the illusion. The developer ran this breakout strategy across 11 overlapping 10-year windows on the S&P 500. Without accounting for any bias, the strategy produced a massive average compound annual growth rate, or CAGR, of roughly 27%. It looked like it beat the market every single time. But the moment they stripped away that hindsight bias, the true average CAGR plummeted to just 11.1%, and it only beat the index in 5 out of those 11 windows. That initial 27%, it was a total mirage. So how do we fix this? Section 4, Point-in-time reality check. To find the truth, the tool builds in a point-in-time, or PIT, reality check. The backtester physically scrapes the current constituent list from Wikipedia and then scrapes the historical tables of additions and removals. It literally walks backward through time to reconstruct the exact index membership day by day. Because of this, stocks are only eligible to trigger buy signals during the exact days they were actually in the index. It completely strips away that forward-looking inclusion bias we talk about. This reality check actually revealed something absolutely fascinating about the structural design of the indexes themselves. It turns out the S&P 500 is highly vulnerable to this bias. It has super high turnover, constantly turning out failing companies and replacing them with rising stars. So, a naive backtest on the S&P 500 gets incredibly flattered by hindsight. But the Nasdaq 100? That's a much smaller universe of about 100 stocks. The new additions there tend to be growth-to-growth substitutions rather than replacing bankruptcies. So survivorship bias has a surprisingly smaller impact when you backtest against the Nasdaq 100.
And the data backs this up beautifully. Even with the rigorous point-in-time reality check applied, meaning we've stripped away all the fake, cherry-picked winners, this custom breakout strategy still absolutely crushes the Nasdaq 100. It delivered a 25.5% average CAGR, and it beat the tech-heavy QQQ benchmark in all 11 out of 11 sliding 10-year windows. It turns out momentum strategies just really favor the tech sector, especially when you apply a strict 20% trailing stop to manage those inevitable drawdowns.
Finally, let's look at how this is all built. Section 5. Under the hood. The developer essentially provides two different flavors of the app for the user experience, both running on the exact same backend. There's a Streamlit option, which is brilliant for quick testing because it just runs as a simple single Python process, no Node.js required at all. Then, for users wanting a more premium, polished experience, there's a React plus Fast API option. That one gives you a highly customized UI with TradingView charts, though it does mean you're managing two separate processes.
Underneath it all, the tech stack relies entirely on modern, accessible data science staples. You've got Python 3.11 and Fast API handling the back end, Y-Finance and Pandas doing the heavy data lifting, and TradingView lightweight charts rendering those beautiful animated equity curves on the front end. It's a remarkably clean setup. But hey, there is a catch here, and to be fair, the source material is incredibly transparent about this. Even with the advanced point-in-time composition, you still get something called residual survivorship bias. Because this tool uses free data from Yahoo Finance, it runs into missing data. When companies go bankrupt or get delisted, think of a Lehman Brothers situation, their historical data often just disappears entirely from free databases. In fact, roughly 150 to 175 historically removed S&P 500 constituents simply fail to download. And because those historic losses are completely absent from the simulation, even these incredibly rigorous PIT results are still going to be slightly optimistic. Which brings us to our final takeaway. As the project's own disclaimer states, backtested results are based on historical data with known limitations and do not guarantee future returns. This open source tool is a game changer. It proves that while we can use code to filter out massive hindsight biases and build incredible momentum screeners, free data is just never perfect. That backtesting illusion, it's always there waiting to trick you. So armed with this knowledge and these tools to enforce point-in-time reality checks, the real question is, are you truly ready to test your own algorithms against the unforgiving reality of the real world?